Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jon Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live from New York City this afternoon. Good afternoon for our audience worldwide. That Fed decision 27 minutes away, with equity markets positive on the S&P 500 by 0.4%. And how about this for a promo? Earlier on today, Francis Donald from RBC. I can't remember the last time I spent less time thinking about a Fed decision.
Well, that sells it.
Look, to me, though, you take a step back. And not that much has changed in markets since the Fed's decision on March 19th, and yet everything has changed on a broader level in terms of people's outlooks, and how they reflect that will be important and interesting. And certainly the markets will respond as much as they say that they're not going to.
I don't think there's a policy chapter on this in any monetary textbook. I mean, this is absolutely original. It starts at 1600 Pennsylvania Avenue. Do you think, John, they're going to be watching today from the White House?
Watching what? This news conference or the football at 3 p.m. Eastern
Well, we'll get to the football in a moment. I think Arsenal really, did they have a chance?
You think they got the edge on PSG?
I'm not
Honestly,
sure.
That's about how serious some people are taking this news conference later. It's important. Here's why. We've seen a generational shift in trade policy in the White House, in the nation's capital, and this Fed is stuck between a rock and a hard place. This chairman has emphasized anchoring inflation expectations, facing down potentially downside risk to growth, upside risk to inflation.
Yeah, Bob Michael of JP Morgan reminded us that it was just last meeting that the T word was rolled back out, transitory, which is rather shocking considering the sea change that has occurred in the meantime. That is the key question. How do they message going forward what type of inflation we end up getting at a time where not only have we gotten the tariff announcements, Liberation Day, but also the first negative real GDP print? How do they message that?
I ran into Anna Wong. She was getting in at the crack of 11 a.m. and she's back to October. I think there's some real debate here about which meeting and when, and she says the uncertainty is so great, she moves back to the autumn.
The data has been resilient so far. Anna Wong, though, pointing out it might not be that way after you take a sneak peek of what the data will look like for the month of May. Equities at the moment firmer by 1/3% on the S&P 500. A lot has changed in policy. To Lisa's point, at the index level on the S&P 500, not much has changed at all. Where you have seen a change is in the FX market. The last time they met, we were sub 110. Right now on euro dollar, 113.41.
Yeah, and gold up 11% in that period of time. Coming up shortly, don't miss this, JP Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Julia Coronado of Macro Policy Perspective. They will be taking us up to that Fed rate decision at 2 p.m. Eastern that everyone is on tenterhooks to try to understand what it possibly could be. Then immediate reaction from former Fed Vice Chair Rich Clarida, Diane Swank of KPMG, and Deutsche Bank's Matt Lazzetti. And finally, the scintillating words of Chair Powell after his news conference. Former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg will be joining us. And I can tell you, I am excited for this press conference.
I'm not excited about it. Can I say that? Joining us now is Bob Michael at JP Morgan. Let's see if he's excited. Bob, let's get to it. What a change since March 19th. A massive change to policy. What's changed for this committee today?
Well, they've got a lot to consider. They know that there are these two big policy initiatives out there. One on renegotiating and re-engineering how the world trades with each other, not small in and of itself. And Congress is busily beavering away on a tax and spending reform package. So both of those things are seismic for the Fed to consider when we see the details. And until we see the details, they're probably a bit like us, bewildered as to what to do.
Do you think they're going to roll out the T word again?
I think that's going to be retired. I don't believe that makes sense right now. No matter how you model tariffs, whether you think this will end up closer to 10% or in the worst case scenario, somewhere closer to 20%, it is a tax on businesses and households. And that tax, of course, is a price increase, and we don't know how it will be embedded going forward.
Bob Michael, my book of the summer, Ken Rogoff, just out 2 days ago. You spent some time with Dr. Rogoff at JP Morgan. He did a paper 25 years ago on Rudy Dornbush about this fearful word, overshooting. What is the risk to this institution, our central bank, that they get this math right, they get it wrong, the calculus wrong, and they overshoot or undershoot some of these important policies?
I think it's actually pretty low. I think relative to 25 years ago, when Ken and others were looking at markets and policy and data, they didn't have the volume of real-time information that they have today. I think the other thing very important about the Fed, they have a lot of powder that's dry. They could come in, they could cut rates several hundred basis points if they need to. They could bring rates down to 1 or 2%. They're not at 1 or 2% where they were going into COVID. And if inflation expectations become embedded, they could go up 100 or so basis points. And then there are all the other policy tools they have in place. They have the balance sheet. They could dial larger or smaller, and then they have all the facilities to buy security.
This is a really important observation because they've tested lots of these things, which we haven't in previous conferences.
They've tested a number of these things, but this is a different era. And I think it's important to know what John's pointed out, that there has been a sea change in markets. It hasn't been in the bond market. It hasn't been in the stock market. It's been in the currency market. You've seen the dollar weaken dramatically against all of its peers. How much does that remove some of that firepower from a Fed that is dealing with potentially a new backdrop for the bond market and, frankly, for U.S. assets more broadly?
I think that's the question for Jay Powell at the press conference. The Sell America theme, how do they define it? What are they looking at to gauge whether it's actually happening or not? Is it institutions selling dollar assets in retaliation for terms of trade, or is it normal portfolio rebalancing? From our perspective, we think what we've seen so far this year is normal portfolio rebalancing. And yeah, there have been some lever trades that have been squeezed out that have exaggerated the moves, but we're not seeing the big holders of treasuries that are overseas, that are structural buyers, coming in and dumping them. But I think he has to pay attention to that.
Can you explain that? What is normal portfolio rebalancing? What's the difference, and how do you identify between the two?
Well, it's looking at a portfolio and thinking there's a lot of opportunity out there. Are you crowded into one specific trade or area? And the dollar became a very crowded trade. And we saw that from our client base. We saw a lot of overseas buyers just wanting to hold dollar bonds unhedged. And of course, we've seen that in the equity market, whether it's the Mag 7 or U.S. equities in general, they took the lion's share of flows.
You speak to those international investors. Have those conversations changed? Are they worried about other people repatriating investments back into domestic currencies, a home bias taking hold of their investments, and are they looking to get ahead of some of that? What are they saying to you?
So the large-scale official institutions right now don't see the Sell America trade. They're happy holding what they're holding. They hope that the trade negotiations progress palatably and things fade somehow. When you start talking to wealth management platforms and distributors, yeah, they're thinking about maybe we just got too crowded into the dollar. We have a European client base. Why don't we bring some of that back to Europe and put it into the U.S. equity or bond market? I think that's relatively normal. We were looking for that anyway.
We keep going back to this, Lisa. We've talked about it a million times. Is this a cycle-level shock, a rebalancing, or a system-level shock, where people start to diversify from the US dollar because the White House, the administration, is absolutely determined to rewire the international system and change the system? And I think the risk is that international investors start to worry that it is the latter and make a move ahead of time.
And take that a step further. For Fed Chair Jay Powell, how do you deal with that level of uncertainty, not only of the economic backdrop, but also of whether it's a regime change that fundamentally changes how they respond, because their function as central banker to the world has been greatly diminished?
Is the answer do nothing and wait? Just wait and see. Get through the summer and see what it looks like.
And I think you go to the press conference and you only use 3 phrases. Solid for anything that refers to the economy. You talk about the labor market being solid. Anything that refers to inflation, you throw out somewhat elevated, and hence you have the moderately restrictive policy. And then anything that talks about their dual mandate, you say that everything is well positioned with policy.
Lisa said this a number of days ago. It's Operation Get Out of There Fast. Wrap it up, end the news conference. It's going to be one of those that finishes at like 3:15.
So this is the time when he does a Homer Simpson. There's a shrub, and he just tries to back into it, disappear with his hat still stuck in the leaves. That is what this is going to be.
TK's looking for that meme.
I'm looking for
when he disappears into the bush. Do you know that one?
Yeah, I know that one.
He sort of backs
I've
away
seen
into
every
it.
episode, John.
Yeah.
It's heritage.
Including the football one, which you
heritage
really like. I know.
We like the football.
I know you really do.
Between that and Toto, it works.
Do you know, he used to troll me all the time when we first started doing radio together. He'd start the segment and he'd play the Simpsons and the football commentary.
Oh, boy.
What was it? Back pass? Back pass, how did it go? Something like that, right?
Captain of the midfield the captain, and
back to the keeper.
And then we play Toto Africa. We could play Toto Africa today, John.
Let's not do that.
Oh, man.
Bob Michael's going to be sticking with us, I'm pleased to say, to talk about markets. Kathy Jones of Charles Schwab joins us in just a moment, alongside Julia Coronado of Macro Policy Perspectives.
I can't remember the last time I spent less time thinking about a Fed meeting.
They will do nothing on rates.
There's no reason for the Fed to be cutting.
We don't think they should be cutting.
We expect cuts this year, but we just don't expect them, immediately.
Wait for more clarity.
Wait and see.
I don't think they can offset a full impact of the trade war.
It puts the Fed in a tremendously difficult position.
The Fed's hands are tied.
They're very timid in how they're approaching this.
They're going to move relatively slowly.
The Fed should continue to remain on hold.
On hold for a longer period of time.
The Fed is really between a rock and a hard place.
Chair Powell is going to have to master the art of saying nothing.
The desire is to get out of this without making any news.
60 minutes of tap dancing coming right up. The decision 15 minutes away. 30 minutes after that, 2:30 Eastern Time, a news conference with the chairman, Jay Powell. Your equity market this afternoon shaping up as follows. Snapping a two-day slide on the S&P. We're positive by just 0.2%. In the bond market, back on March 19th when the Fed last met at the close, the 10-year, 4.24. Today, 428.10. In the FX market, a lot has changed. Euro dollar, the last time these guys met, 109. This afternoon, 113.38. Lisa, huge change in the FX market.
To me, this is the big change, and it's the one that Fed Chair Jay Powell will avoid at all costs, because ultimately it goes to the heart of the question: how much is this just a sea change in expectations globally, and how much is a fundamental shift in the dollar as the reserve currency?
And also, I'd say very importantly, and you really see it through BBDXY, the Bloomberg Dollar Index, EM currencies are doing some strange things. I looked very carefully today at the Taiwan dollar. When was the last time I did that? When Tottenham won. And the answer is, I look at Taiwan dollar, John, and it's very fragile. These shifts in the Pacific Rim are for real.
Lucky not to get relegated, Tottenham.
They're very close.
Not a good season.
I can't sleep.
We're not going to talk about that, okay? Big dislocations in FX markets. To discuss, Bob Michael at JP Morgan, still with us around the table. He'll be with us through the decision and approaching the news conference. And joining us now, I'm very pleased to say, Kathy Jones of Charles Schwab. Kathy, welcome to the program. No new forecast from the Federal Reserve at this meeting, but I wonder, just a thought exercise, if we had an SCP today, if we had an update to the forecast from the FOMC, how much do you think those forecasts would change?
Well, I think they would change and indicate more of this sort of stagflationary environment, with inflation remaining elevated and growth slowing down. Most of the data that we've seen, other than, say, the employment report, does point to the idea that we're getting slowing growth in the second half of the year. The question is, what will they do about it?
There are a number of questions about how different the feeling will be in this speech, in this press conference, than the one just on March 19th, including the transitory word, which Bob Michael is talking about. He doesn't see that making a comeback, but also the soft data versus the hard data. How much do you expect Chair Powell to reaffirm the idea that the soft data has not necessarily cohered with the hard data, and they're watching the hard data much more closely than anything else?
I would suppose that he'll make that statement that, the real economic data that they're watching, the real-time data, is still holding up, especially the labor market, and therefore there's no reason to adjust policy right now. I think the bigger question for me is, how are they assessing the inflation expectations component? Because that's where we're starting to see less well anchored, I would guess. Last time in the press conference, Powell indicated that inflation expectations are well anchored. And we've seen evidence that that's kind of giving way. That anchor isn't as firm as it was. So I think that's going to be a tough question for him to answer. And I'd be curious to see how the Fed is thinking about that.
Hey, Cassie, I wanted the LIBOR, where everybody dressed up in a tuxedo and figured out where interest rates were for cocktail hour. LIBOR's gone. We have SOFR. You had a very smart comment today on SOFR, SOFR, at the 2-year rate. What do you see in the short-term trust market now when you look at 2-year SOFR swaps?
Yeah, what we're seeing is this divergence between expectations and where we are, right? So you look at CPI swaps, and by the way, I have to give credit to Bloomberg Intelligence for pointing this out. But it does look to me like we're starting to see those swap rates reflect inflation expectations staying higher, or inflation staying higher down the road than what we're seeing in the SOFR market, which is more rate-based. So it'll be interesting to see how the Fed kind of brings those two together, because inflation expectations are a big part of their policy setting and a big part of how they see what they do affecting the markets.
Hey, Kathy, I love hearing what you tell individual investors to do in environments like this. What are you telling them to do in environments like this?
Yeah, we're hoping that they've been following our suggestions for the last 6 or 8 months, and that is just a intermediate term duration, meaning 5-7 years, maybe a little bit beyond, even given the slope of the yield curve, in high credit quality bonds. And try not to time the market with being too short and saying you're going to roll in when things change. Try not to be too long and take on that interest rate volatility. But we want to stay up in credit quality, intermediate term, and more internationally diverse, because the dollar does look like it's turned, and we think it's going to continue to work lower over time. Of course, tariffs are a wild card, but for the first time in a long time, international diversification in developed market bonds looks like an attractive proposition.
Bob, it's interesting. I've heard this argument quite a few times now. This comfort level with the belly of the curve. If you ask anyone in fixed income, look along the curve, where are you comfortable? And I keep hearing the 5-year. And then I say, what about further out, 10s, 30s? Do you think they'll rally if we get into some trouble here in the economy? And they've got doubts. What's your reaction to that argument?
Yeah, I think everyone's worried about a stagflationary environment where the Fed actually does come in and start bringing rates down because unemployment starts shooting well above 5%. And in that environment, the front end of the curve will reprice to where the Fed funds rate. However, if you're going to be in the long end of the curve, particularly 30 years, you want some real yield out there, and you won't be getting it if inflation shoots up towards 5% as well. Let's build on this conversation. Joining us now is Julia Coronado of Macro Policy Perspectives. Julia, a big conversation about whether this Fed can ease in the face of weaker growth prospects. Now, at the last meeting, as you saw implied by the SEP, they took their growth expectations down, but didn't dial up the median dot for rate cuts. Julia, from your perspective, what are you telling clients about the ability of the Federal Reserve to respond to weaker growth?
Well, their ability is definitely more limited during the last than during the last trade war, when inflation was below target. So by definition, with challenges to both sides of your mandate, and you're starting from a point where you are exactly on the longer run estimate of the unemployment rate, but you're still a solid 0.5 percentage point plus above your 2% inflation target, you have to be a little bit later. You have to gather the information. The bar for what you need to see in terms of weakness in the economy is a little bit higher than it would be otherwise. Last time around, we got preemptive insurance rate cuts just to cushion the blow to the manufacturing sector. Now we're looking at a multiple times increase in tariffs, a much harder blow to the manufacturing sector. But, again, the inflationary backdrop is very different, and potentially the international trade-offs that you guys have been discussing are also very different. So the Fed really needs to be cautious here.
Julia, if we get a Bob Michael 5% CPI, my math is 2.4% to 5%. Maybe it's a little less. That's a 108 percentage point move in the inflation rate. All of our viewers and listeners are going to be crushed by that.
Yes.
How quickly does the Fed move? Should we anticipate 50 basis point cuts?
For sure. At some point, I think that's a perfectly reasonable expectation. Again, the bar is higher. It has to be a pretty decisive indication in the labor market data that we are sliding into a recession, that we have gone from the positive feedback loop of growth to the negative feedback loop of contraction. Then the Fed is going to turn to that side of the mandate. If you look at peak to trough declines in core inflation in the average business cycle, it's several percentage points. So it still is a sort of law of nature that inflation is likely to come down in a recession. And you're starting from a much higher point on interest rates than we've been in the last couple of cycles. So there's room to move. And of course, we can imagine in the scenario where we're seeing losses on non-farm payrolls and a rising unemployment rate, financial markets might also be tightening conditions, and the Fed will need to signal that it is on the case. And so, yes, I think a 50 basis point move at some point is a perfectly reasonable expectation. When that is, we would really have to see the rollover in the hard data.
Just a look at what these markets, these investors and these officials are up against. Bring up the S&P 500. We've just taken out all the gains for this afternoon on one headline from the President of the United States, Lisa, saying no to the potential for pulling back tariffs on China. As an official of the FOMC, how do you set policy for this when you can dial up and down tariffs whenever you want in the White House, and that can have a profound effect for how people perceive the risk to the outlook?
This is the reason why Fed Chair Jay Powell is going to try to disappear. He also is asked about President Trump about tariff exemptions for baby items. I don't know. We'll see who says I'll be the one to sign off on this. There is a level of uncertainty that's starting to make its way into the hard data, with companies starting to price that in as a level that they have to guard against.
Kathy Jones is still with us. Kathy, I want your thoughts on this headline. We were going into a meeting this weekend between the US and China. A lot of people were hoping that that would mean tariffs eventually would come down for a bigger set of negotiations down the road. How do you respond to that headline? And what does it mean for the FOMC as they get together today?
Yeah, I think this is the toughest part of Jay Powell's job right now, because there's so much unknown about the tariff policy, and it can change in a heartbeat or with a Truth Social post. And how do they assess then what the impact of tariffs will be on the economy if they don't have the tariff rates yet solidified, or if they can change really quickly? And the second part is, how do they know that their interest rate policy will have that much impact if it's a supply side shock that we're getting? So I think that's a really, really tough thing for the FOMC to deal with. And I think they'll take baby steps and be very cautious until they get some information. But as you pointed out, this can change day by day, minute by minute, and setting policy is not done on a day by day, minute by minute basis. So it's going to be really tough.
This makes it super difficult to act preemptively. And Bob, it's the reason why a lot of people have been with us around this table and said they're going to be late. They've got no choice but to be late. Is that how you see things?
My London-based fixed income team sent me something this morning which terrified me. They liken the current environment with tariffs to Brexit, where you can sit there, you can model all the impacts, they're all to the downside. But because you haven't seen the impact yet, there's a complacency that takes hold of the markets on the expectation it will be worked out somehow. And it wasn't, and the downside was realized. I hope this time it gets worked out in advance.
Bob, the new ex post that we're living in, I got two ex posts. I got an ex post on interest rates and, you know, the shock of 5% inflation if we get there. And I got an ex post on the labor economy. I don't think any textbook has how they dovetail together. To me, it's almost a squared function. Is our new ex post, is Jerome Powell's new ex post, is it something absolutely original?
I don't think so. I
think it's business as usual?
I think they have no choice but to look at their dual mandate and try to balance the labor market with inflation. If they can't save both, which is it more important to save? And I think they'll choose the labor market and the economy and hope at some time inflation will run its course.
Bob, can you just build on what you were saying in terms of those comments that scared you? The downside, do you still see people flooding into long-term treasuries if that downside is realized? Or is that part of your concern in terms of some sort of relevance with Brexit and Liz Truss?
Well, it is part of my concern. And The other thing that did change from the March 16th FOMC meeting, the front end of the curve is down 20, 25 basis points. The 30-year is up 15 or so basis points. So that's already starting to become manifest in the pricing of the curve. I think what we learned from Brexit is you knew the supply of labor and goods would be cut off. You knew inflation would reset higher. And you knew that would create a hit to the economy. And everyone hoped that there would be some moderation around that. And I think that's the overall concern that investors are trying to weigh now. How significant will the inflation shock be? Will it actually fade next year, or will businesses have no choice to pass that along? Consumers have no choice to pay it, and then you're caught in a wage price spiral again.
And this is the challenge for investors. We asked the question this morning, just how much can the promise of deals sustain this market? The promise of deals has driven this equity market higher to a significant rebound. So you sit there waiting and waiting. And to Bob's point, complacency can come into it. And all of a sudden, it's this slow erosion of the economy as a lot of people just snap into this wait-and-see mode. And before you know it, you hit an air pocket in the economic data. And you've got to respond to that too.
Suddenly you get a jobs report that is not what people are looking for. I wonder how soon it will come, if it's possibly next week with inflation. Ford said it wasn't going to raise prices on vehicles in response to tariffs. It is raising prices. It is the test out there to see whether consumers will actually absorb it.
That decision is just seconds away. Your scores going into it look like this on the S&P, erasing gains on the S&P 500 as the president says he's unwilling to lower tariffs to get China to come to the table. With your Fed decision, here's Mike McKee.
There is no move, but there is a warning. The target range stays in the range of 4.25% to 4.5%. But Fed officials warn, quote, uncertainty about the economic outlook has increased further. And they go on to say they, quote, judge that the risks of higher unemployment and higher inflation have risen. The economic assessment has changed. After last week's report, the economy contracted in the first quarter. Although swings in net exports have affected the data, the minutes say, recent indicators suggest that economic activity has continued to expand at a solid pace. No change to their view. The labor market remains solid. Unemployment has stabilized at a low level in recent months, and inflation remains somewhat elevated. No other changes to the statement. Again, the committee will assess incoming data, the outlook, and balance of risks in considering the extent and timing of additional adjustments to the target range. There's no change in balance sheet policy, which was adjusted in March, and the decision was unanimous, with Minneapolis's Neil Kashkari voting as an alternate for Kansas City's Jeff Schmidt.
And our thoughts are with him. That's for sure, given the circumstances that led to that. Mike, thank you, sir. Mike's on it. Second paragraph at the very bottom of it. The committee is attentive to the risk to both sides of the dual mandate and judges that the risks of higher unemployment and higher inflation have risen. And that is the central banker's dilemma.
The stagflationary environment that every central banker wants to avoid. The initial knee-jerk response in markets is interesting in that its yields lower. There is a question whether that can continue all across the curve, as there's a question around just the new structure of trade and the uncertainty that is weighing on businesses.
The problem is with the market response, Bramo, as you know, we're competing with the headline from the President of the United States, which is perhaps more significant than anything we hear from Chairman Powell in 28 minutes' time.
OK, fair enough.
The President coming out and saying we're unwilling to lower tariffs to get China to come to the table. That's what they're confronting in this meeting. How do you set policy for this when for the moment in time, that's the headline? But that could change again this weekend and again next week and the week after that.
How much is communication a monetary policy tool when you're communicating the same thing that everyone's communicating, which is we have no clue and we are waiting for that tweet or truth that's come out and give us some sense of where the next move is going to come from?
With us around the table, Bob Michael of JP Morgan Asset Management, and our guest for the next 28 minutes going into the news conference, the former Fed Vice Chair, Rich Clarida. Rich, thanks for dropping by. Important conversation. Look, a lot of people say this news conference is going to be boring. I get it. You're not expecting a big change. But they face a really big dilemma. The dilemma that they articulate in this particular statement this afternoon, the prospect that the dual mandate is in conflict. Rich, what do you do when the dual mandate is in conflict?
Well, you wait and see for a while, and I would note that the language appears to me to be quite similar to the remarks the chair gave a day or two after Liberation Day, so not the first time he's telegraphed a change in statement language from a speech. I still believe, and I think I've said on this show before, that if the labor market cracks and they see tangible evidence of a weakening labor market, higher unemployment rate, negative payroll gains, I think they will move. So in that sense, once they see tangible evidence that the labor market is weakening, I think they will cut, but they're not going to cut preemptively based upon a forecast it might happen.
I see instabilities out there, Dr. Clarida.
Many of them.
Turn to Richard Clarida in the Financial Times, taking us back 40 years to Plaza and Louvre.
Yeah.
I've got EM currencies moving.
Yeah.
Some of them are moving 4 standard deviations. Do we, and particularly does President Trump not understand that his tweets can shatter the financial system?
Well, I'm not sure about that. I will say that, coming into the year, there was some commentary, including by now CEA Chair Mirren, from his work of last year, which was sort of dangling the idea of let's weaken the dollar, let's do other things in the Treasury market. And I thought that was a risky move. And I've noted since then, including at the IMF meetings recently, he's sort of walked that back. And Scott Bessent, including when he's on Bloomberg, says he's in favor of a strong dollar. So maybe they're trying to put that genie in the bottle.
As a student of this history, do we underestimate the potential shocks that are out there? Are we all too complacent, except for Jon Ferro?
Well, I would hope we're not complacent. But yes, the world economy has operated for 40, 50 years in a particular regime, a dominant dollar, more or less credible U.S. monetary policy and innovation and all of the rest. And, regimes don't necessarily last forever. So I think there is that risk. I don't think it's front and center right now, but I think there is a risk, sure.
Bob, you've had a second to digest all of the headlines as they've come out. Did anything stand out to you as noteworthy or telegraphing how they are going to deal with this dilemma?
They did put in the risk of higher inflation and higher unemployment have risen, so they've taken a pass on having to determine which of the two they place greater value on. And I guess, Rich, I have a question for you. You've been at the table with this. We know 4% core personal consumption expenditures are 2% away from their target. What's 2% away from their unemployment target?
Well, I think right now we're in an environment where I think they've telegraphed, and I believe them, that any appreciable move, 0.5 point, 1 point in the unemployment rate is going to get them off, and the dime and start cutting rates. And so I don't think you need to calibrate, and they're probably not calibrating it too carefully beyond that. And it is a risk. I think, as we've all said, there's a two-sided risk because we've had 4 years, including one in which I was there, in which inflation was not transitory. It was above target. This could be the 5th year in a row. And I think that's why they're looking at inflation expectations.
Equity markets rolling over this afternoon. As Lisa pointed out, bond yields are lower. We're down by 4 basis points on the 10-year, 4.26. When they last met, March 19th, at the close, 4.24, almost bang in line with where we were a number of months ago. But a lot has changed, which is why this line pops up in the statement. If you're just joining us, no change to policy. No change to policy expected, but some new language here. The committee, attentive to the risks of both sides of its dual mandate, and judges that the risk of higher unemployment and higher inflation have risen. Mike McKee, I want to bring you back in before you run off to this news conference. Mike, as you know, those comments at the Economic Club of Chicago a number of weeks ago maybe irked this White House and the President of the United States. What are you expecting to hear later on this afternoon?
Well, I would imagine now that it's in the statement that Jay Powell will stand behind it. And of course, it's what he said in Chicago. Now, the question is, how is the president going to react to this? Because he was upset about the Chicago version of this that came right after Liberation Day. But the Fed otherwise doesn't mention the administration or the White House, except to say that imports affected GDP. So is this a poke at the White House, or is this just accepting reality and trying to get the markets to accept it?
Mike McKee with the latest. Mike, I know you've got to run. Mike McKee heading into that news conference. The news conference, by the way, starts in about 23 minutes' time. Bob, your view on what's happened with central banks elsewhere. The ECB cut interest rates. This president was annoyed by that. Overnight, the Chinese central bank cut interest rates. I imagine this president is annoyed by that. They look at the same policy shock but see a different outcome. Abroad, they believe this is a disinflationary, potentially deflationary shock for Europe. What kind of shock is it for this Federal Reserve?
Well, I think for this Federal Reserve, they're worried about the stagflationary shock. They're worried about exactly what they talked about, which is inflation goes up 4% or higher. Unemployment goes up, closing in on 5%. Now both are kind of at a similar break-even level. What are you supposed to do? I'm in Rich's camp. I think you've got to save the economy, because if you don't save the economy, then you've lost on both mandates.
You live some of this, Rich. I just wonder how you'd live it right now. It's so public, the criticism of the Federal Reserve. As a committee, when you heard these kind of things, you saw the social media posts when you were on the committee.
Oh, my, yeah.
How did you deal with them?
Well, after a while, you sort of get used to it. And what I would note is that there was some criticism of the Fed when we hiked rates in December 2018. And then there was criticism of the Fed when we cut rates in July of 2019. So at some point, you put your head down, you do your job. And of course, the mandate is price stability and maximum employment. And so that's the way I thought about it and the way we thought about it.
Rich, what do you make of the fact that they dismissed the first negative real GDP print in a long time, in years, as simply swings in net exports? Some people would say that's accurate, but the fact that they led off this statement with that really highlights how much they are shrugging off some of the negative economic indicators that are glaring.
Interesting observation. I think there were good economic reasons to shrug it off. I mean, the surge in imports and probably some measurement issues. And I had been thinking and been saying I thought they would shrug it off if it came in negative. That said, it was interesting that they did choose to lead off with that observation. I think that is another way of them saying they think they're in a good place. They'll wait and see. Had they emphasized the negative print, it might have been more difficult to justify what they want to do.
You'll notice this equity market has taken another leg lower. We're down about 4%, 0.4% on the S&P. Don't get too excited. On the S&P. It's not that exciting this afternoon. Let's talk about the why. We've got some conflicting information. At the same time, the Federal Reserve is saying growth potentially could be weaker, unemployment could be higher. They're also facing down the prospect of higher inflation as well. The President of the United States is not backing away from the tariffs from China too. You combine those two stories, you've got a weaker backdrop for risk going into this news conference.
This is the worst of all worlds, especially given the fact that Fed Chair Jay Powell is not going to do what a lot of people thought he would do, which is to come out and say, we're very concerned, we're going to cut rates, don't worry, we got your back. No one thought he was going to say that, but some people were hoping that maybe he would, including somebody at the White House. To me, this represents the dual shock that the Fed cannot address. And to me, that is the key question. What other tools are at their disposal, and how are they watching market functioning as a virtue of that 10-year and 30-year yield at a time of some potentially messy auctions?
To build on that, to extend the conversation, Diane Swank of KPMG joins us now for more. Diane, welcome back to the programme. I remember when we were talking last time around on March 19th, you and I were both in agreement. We looked at the SEP, we saw a weaker forecast for growth and no move to the median dot. We both said this is hawkish. This is a Federal Reserve whose easing bias might be constrained. Dan, do you think they're communicating that a little bit more clearly, even more clearly, in today's statement?
I do, and I guess I disagree a little bit with Rich, and I know he was at the table, but I think back to that 2022 Jackson Hole, Wyoming speech, which was like the there will be pain speech. The bucket of ice dropped on our heads when the Fed was put in a situation where they had to worry about inflation over unemployment, and they thought a recession may ensue. Luckily, it didn't. They were willing to make that decision to go ahead and raise rates anyways because they were behind the curve and still catching up at that point in time. And I think they're still smarting from that period. I also think it's important. I was in Chicago when Jay Powell spoke, and he made an important point in the Q&A, and that is that no matter what, the bump in inflation due to tariffs would be temporary. That means that they hold off a bit before, as unemployment rises, or we get some red ink on unemployment, and then they cut. It is not only not preemptive, they have to wait in order to make sure that inflation's coming back down again in the fourth quarter.
Rich, in preparation for this meeting, I was reading the economist Oscar Wilde, and he said, expect the unexpected. What's your unexpected right now? I got all my radar up. We've all got answers. We've all got analysis. We've got our monetary textbooks out. We're reading Mankiw. Guess what? What's the unexpected out there?
Wow. So I guess we're into known unknowns and unknown unknowns. I guess to me, the unexpected would be if Mike McKee or someone asked Jay Powell today how they would respond to a rise in the unemployment rate if he repeated what he did at Jackson Hole 3 years ago, which is some pain, inflation's too damn high. So that would be the unexpected at this press conference.
What does pain look like? Rich, what is pain? Because quite clearly, if I lost my job, that's painful for me.
Yeah.
if the three of us lose our jobs. I hope it's painful for you. You'd miss out on a lot, I'm sure. I want to understand when it becomes painful for the Federal Reserve. What kind of number is painful for the Fed?
I think I put it out a moment ago. I think round numbers, I think certainly if we got a 1-point rise in the unemployment rate, I think probably even a half-point rise in the unemployment rate in the context of a cracking payroll employment report would be enough. I think probably the only person who knows for sure is probably Jay Powell, so I'm just guessing. But to put round numbers on it, yeah.
Diane, what's your view of this in terms of the pain that would get the Fed's attention at a time where, as Rich has put out, there has been elevated inflation for years above where the Fed has targeted?
Well, and I actually agree with Rich on the degree of which we'd see the unemployment rate go up that would precipitate the Fed to feel comfortable that it could begin cutting because the demand is so weak that inflation will come down. But that is after the fact of inflation actually going up. And remember, unemployment is a lagging indicator, and I think that's important. We also have one other factor out there that we've yet to see fully influence the labor market, and that is whether or not the change in immigration policy results in lower labor supply, which was part of the soft landing scenario, but it also will mean a slower increase in the unemployment rate if we lose the participation of those foreign-born workers. So all of those things together leave us with a period of the economy with maybe red ink in payrolls before the Fed actually cuts. And I think that is the important message. The timing is only maybe a few months apart, but that not preemptive, but also not synchronous, I think is what we have to walk away from.
But Michael, one of the arch things here is Michael Ferroli's thoughts from years ago about such a low potential GDP number. Maybe we got saved by productivity, who knows, maybe it was triple stimulus in that. But in your framework of the debt market, around Clarida's economics, do you just frame in a new lower GDP that we have to get used to?
No, I don't think so. And I think if you talk to Mike Ferroli today, he would tell you that the post-GFC environment has faded. There's a new generation that's in place, call it loosely the millennials. There will be a demand in costs and productive use of capital. So we're going back to an environment that existed pre-GFC. I think what's interesting to me right now is the markets have voted. And if the FOMC is going to tell them that that the risks are higher unemployment and higher inflation, neither of those are good. So equity prices are down, bond prices are up. At least we've got sort of right-way correlation today.
John, have we heard from President Trump yet?
Not yet, not on the Federal Reserve directly, Lisa, but I think he's shaken up this market already.
I was going to say that the fact that he said he was unwilling to lower tariffs to get China to the table is a pretty big headline that maybe is getting more of the attention in markets than elsewhere. But Rich, to Bob's point, and this is a good one, and it's one that actually Treasury Secretary Scott Bessent made just a couple of days ago, the two-year yield is screaming that the Fed should have already cut rates. Yeah. Do you buy that type of reasoning, that this market is pricing in a slowdown that the Fed should preemptively respond to?
The market is pricing in a material probability of a recession, and Secretary Bessent's entitled to say then the Fed should cut. I think what we're hearing and what we'll hear today is that's a risk that they're willing to take given the history of inflation and given what they see down the pipe. So the markets are pricing in 40, 50% chance of recession. And as you pointed out 5 minutes ago, the past 30 years, the Fed typically already by now would be in preemptive mode to ride to the rescue. But again, history is relevant here, and that's why this time is going to be a little bit different.
To ask more directly, though, what do you make of the specific argument that the Treasury Secretary is pushing? The idea that the two-year yield is traded below where Fed funds is, and he believes that's a sign potentially that the Fed's too tight and the market's telling them to cut. Is that a good measure of things?
It's a sign that the probability of recession has gone up, and that in that scenario, we all think the Fed will be cutting. The difference is that I don't think, anyway, that the Fed's going to be cutting to try to get ahead of that curve. As Diane said, the very real risk is that they're going to be late, and certainly not early.
Diane, based on that, how much has the risk of recession gone up just in the past couple of days, given the fact that it seems like the Fed is going to reiterate that point?
Well, our view has been the risk is 60% for some time now, and I would bet that poly markets are probably back up to 60%. They had come down just a little below that in recent weeks with hopes of more toned down rhetoric with regard to trade tensions, and now that's being unwound today. I think the risk, what the Fed has to do, and Rich knows this as well as anyone, and what we're doing, and it's a lot more work, is probability and scenario analysis. Yeah. That's all we can do. We put on a certain probability on what tariffs will be in different kinds of regimes and how they're likely to play out, and and sit down and think about how would the Fed, stepping in their shoes, have to react to all those scenarios. So our recession scenario is 60%. Probability.
The companies are doing the same thing. Diane, just before you run, that news conference starts in just a moment. Your number one question for Chairman Powell at the moment, what is it?
Well, again, it gets down to how much pain are you willing to endure before you feel you need to cut? And that's, Rich has answered it. It would be nice if Jay Powell answered it. I don't think he will, but it is one that we all need to know is, what is the pain threshold and the trade-off for the Fed? And how late are they willing to be?
Diane, thank you. Appreciate it, as always. Diane Swonk there at KPMG. We've had the decision from the Federal Reserve. No change to policy. The news conference starts in about 11 minutes' time. This stood out in the statement. If you've not read it yet and you're just joining the programme, welcome. This stands out. The committee is attentive to the risk to both sides of the dual mandate and judges that the risk of higher unemployment and higher inflation have risen. To discuss, Matt Lazzetti at Deutsche Bank joins us now for more. Matt, welcome to the programme. Is that your assessment of things as well? Do you share that view of the FOMC?
Yeah, I think no doubt. If you look back relative to March, uncertainty has clearly risen. We've gotten tariff effects and tariff announcements that were substantially larger than anticipated. Downside growth risks to the economy have clearly risen. Upside risks to the unemployment rate, inflation risks are clearly higher. So I don't think anybody really debate at the moment that risks are far more elevated today than I think that they were back in March, and from a stagflationary perspective, that inflation is likely to be higher and the unemployment rate is likely to be higher.
It seems like there's a bias right now in markets, Matt, that the unemployment rising feature of this dual mandate is actually more important than the inflation side of the mandate, and that if unemployment rises enough, the Fed will respond to that even if inflation is still elevated. Do you think that needs to be pushed back on, that maybe that's not the bias that should be there?
Look, I think that's right to be the bias. The question is always kind of thresholds for which the unemployment rate needs to rise to get the Fed to act. And there I do think that the market may just be anticipating that the threshold is lower than what the Fed is actually willing to deliver on. At the same time, I think you do have healthy dynamics. I mean, we got a better ISM report, ISM services, you had a jobs report that surprised to the upside. With that, we've substantially taken down the probability of cutting rates by June. Now, a lot of that's getting priced out to later meetings. But if I were the Fed, I wouldn't be too perturbed by market pricing at the moment. They probably agree that recession risk is elevated. And we'll just kind of have to see how that plays out. I think importantly for them, the market is responding to stronger data by reducing near-term rate cut probabilities.
Matt Lazzetti, David Folkert's Landau got it right. He said there would be a new Europe, there would be a new investment in Europe, maybe a new nominal GDP, a higher pulse, if you will, for Europe. That's one of the unexpecteds here. What's the unexpected you're looking for that we're not talking about?
Look, I liked Rich's unexpected, which is that Chair Powell highlights that we're willing to take pain here. I don't really anticipate that we get that. I think near-term unexpected would be if he kind of gives clarity that they're still in no rush to cut rates. Essentially says that June is probably off the table. I think at the moment the Fed is likely to just take a step back, not provide much forward guidance, let things play out as they come. But I think importantly for them is going to get clarity on two things: trade, but also fiscal policy. Because I think if fiscal policy and tax cuts are larger than anticipated, then this turns into something that looks kind of like a mini COVID shock. You have a big supply side shock from tariffs, immigration being coupled with a demand side stimulus from tax cuts. And I think the Fed will really want to see both sides of those policy decisions.
You're fired up about this, but take it internationally. Take it to the stimulus in Europe, to a higher nominal GDP, the true unknown unknowns we don't understand about a China fiscal policy and the mess that's in Washington.
I guess on both those, Tom, I'm even though I grew up in Illinois, I'm from Missouri on those. I mean, the Europeans have talked for decades about this. We get it, more demand growth, more fiscal space. The Germans maybe will pull it off. What I'm hearing from my colleagues in Europe is it's not clear the rest of Europe is going to do that. Again, the same with China. I mean, we've been talking about boosting consumption, being less reliant on exports in China for 25 years.
And you're still showing me.
So I'll believe it when I see it.
When you say Missouri, our international audience has no clue what you're talking about.
Can I just say I appreciate the healthy skepticism regarding Europe? Because it's kind of been ridiculous, hasn't it, over the last several months? Well, Europe's the place to be. They've got their act together. Germany might actually do some stimulus, sure. Is the rest of Europe going to follow? How constrained are these other nations?
Yeah, and let's see how long it takes for Germany to get a chancellor. Oh, yeah, we finally got that. So there is this question about how it comes together, which goes to the heart of the issue. How big of an existential threat is there that the Fed has to face, having to do with the exceptionalism and, frankly, the preeminence of the dollar?
Matt Lazzetti, before you go, when have you penciled in the first rate cut for from this Federal Reserve?
We still have December as the first rate cut. We have them cutting 75 basis points through March. And really, our view is that in the near term, you're going to see elevated inflation. The pain threshold for the Fed is going to be elevated because of that. I kind of think as they begin to see unemployment rates that are 4.5% or 4.6%, then it becomes a greater debate about cutting rates to respond to the downside risk to the economy versus the elevated inflation, which certainly is a concern for them. If inflation expectations pick up, I think that could be pushed out further into the future, but I would view the risks as them cutting a bit earlier, certainly if we get downside realizations on the economy with the unemployment rate rising faster.
Hey, Matt, thank you. Matt Lazzetti at Deutsche Bank. One cut, December. You can drive a truck through the range of estimates on Wall Street right now.
Yes.
Forget
Accurate.
market pricing.
Accurate.
That's just averaging out a wide range, an incredibly wide range of outcomes. I've got Morgan Stanley and Mike Gapin at 0 for 2025. And on the other side, Andrew Honhorst of Citi at 125 for 2025. That's a very different view of the world going forward from here.
A real lot of it has to hinge on when the hard data rolls over.
Yeah.
How long does it take? Because that is going to be the whites of the eyes that the Fed will respond to.
That's 5 Fed meetings away. Think of the drama we could have.
Could be a lot of drama. Do you want some good news? Take a look at the market screen. Equities roll over, down 0.25% on the S&P. Look what happened to bonds. Bonds actually rallied. Bob Michael, music to your ears. Bonds are doing what bonds are meant to do. Do you take some comfort in this move?
Yeah, and that's what we're hearing from our clients. They felt that they were underallocated to fixed income. They've been coming into the markets. They're a combination of institutions buying taxables, foreign official institutions buying treasuries, and actually individual investors coming into the municipal bond market. So I think we're going to continue to see a lot of flow across bond markets.
This is something that clearly Treasury Secretary Scott Bessent has been looking at very closely. He talked extensively about this today. He's even looking at the auctions and the dealer take-up of potential auctions. I'm just wondering what would get you nervous and how much can the Fed respond with bond buying? How much their balance sheet potentially is going to be on the table later this year, especially as they become politically enmeshed in the fiscal aspects?
I'd get worried if both ends of the Fed's mandate got pulled to extreme levels. So core personal consumption expenditures up over 4% and unemployment up close to 5%, and they still feel they can't do anything. Then I would start to worry.
Dr. Clarida, what would you do with the dots right now?
Well,
use invisible ink?
Today there are no dots. I think at the last press conference, Chair Powell said, I'm paraphrasing, said something along the lines of, we had to write down something.
Exactly.
I mean, as a student of the dots and then as a dot writer for 4 years, I've observed under all Fed chairs, Bernanke, Yellen, and Powell, since the dots, there are some meetings when the dots tell the story they want to tell and then they embrace them. There are other meetings when the dots, you got to write something. You got to write something down. So I think I would be in the you got to write something down mode right now.
I think a lot of people trash talk the dots, but I do think it goes some way just to emphasising the reaction function at the moment of the Federal Reserve, which is why I want to lean on you just a little bit more to really get a specific from you. If today we had an SEP and they had to dial up expectations for inflation again and dial down expectations for growth, would you leave your dot unchanged or not? Because that goes some way to describing what they would do up against a stagflationary shock. What would you do?
I think I'd probably leave it unchanged, with the idea being the probability on both bad outcomes has gone up and they move in different directions. So I'd leave them unchanged.
What would be your one question right now to the Fed if you were going to ask anything and put Fed Chair Jay Powell on the spot in a way that you thought he would actually answer?
Well, no, that makes it more difficult because Chair Powell's quite good at answering it the way he wants. No, it's what I said several moments ago. Chair Powell, you've emphasized that if there's a weakening in the labor market, that the committee would adjust. Vice Chair, Governor Waller has said that. Is that the case? Or with a 4% PCE inflation rate, can you be cutting rates?
How collaborative was it when the chairman had to go into a news conference like today and he'd offered his personal views at the Economic Club of Chicago? Was it easy for him to get the rest of the committee to get behind him so he could put his own language in the statement?
Well, Jay Powell's very, very collaborative, and he had bilateral discussions with every member of the committee. We did distinguish between the FOMC statement, which is a committee document, and the press conference. The press conference, he reads an opening statement, but that's Jay Powell speaking as Jay Powell. So as I think we've mentioned before, when you look at the opening statement or even the press conference, you want to count the times he says we in the committee versus I, and sometimes that balance goes up and down.
That's an important distinction.
Yeah.
Bob, before we go into this news conference, Chairman Powell will walk out in about a minute's time. You got a quick question for Mike McKee. What do you want to know?
Yeah, I'd ask him about Sell America. How do they define it? What are they watching to see if it actually happens?
Something a lot of investors are thinking about going into this one.
And one that he definitely will not answer. But this is really going to be one of the key questions to really gauge how much the bond market continues to be some sort of counterbalance to risk in markets.
At least bonds are rallying. Isn't that the good news this afternoon?
I guess so. I mean, I guess we could talk about why. We could talk about whether it's some sort of global recession that's being priced in if there's no trade discussion or whatever it might be. But yeah, for now, this is great.
I think we're beholden to 1600 Pennsylvania Avenue. Maybe we'll get a tweet within the conference.
We've already had a headline that's shaken up this market from the President of the United States, the President unwilling to lower tariffs to get China to the table. This is about framing the negotiations into the weekend, but it also frames the risk for this committee. The FOMC, facing down stagflationary risk, articulated in the statement this afternoon, which reads as follows. The committee, attentive to the risks to both sides of its dual mandate and judging that the risks of higher unemployment and higher inflation have risen, emphasising the language, the communication that came from the Fed chair more recently at the Economic Club of Chicago, and clearly the committee getting behind him. March 19th was the last Federal Reserve meeting. April 2nd is so-called Liberation Day squeezed in between. A generational shift in trade policy, totally shaking up the outlook for this Federal Reserve.
Which makes it incredibly difficult for them to give actual forward-leading indicators at a time of such great uncertainty.
It is May 7th, and the chairman has stepped up. Here's the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think, if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 supply shocks. But there are some who argue that the current situation has notable differences. Energy costs are down. Housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling, with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops. And I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, I mean, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. We're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So, again, difficult judgment to make, and not one that we face today. And we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're really not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports
businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So people they're worried now about inflation. They're worried about the you know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so you know, we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there'll be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, you know, what kind of interest rate decisions you will make later this year. So does that, you know, in March, there was guidance that 2 cuts might happen. You know, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
You know, we don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And you know, we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. You know, it could include us holding where we are. We just are going to need to see, you know, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. You know, I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, you know, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. You know, I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
You know, we don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly? I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt. Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Chair Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not. I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
That's the chairman of the Federal Reserve wrapping up the main news conference. The press doing their best to make that interesting. The chairman doing his best to make it boring. And I think he was fairly successful. Your equity market this afternoon looks like this. Equities positive by just 0.1% on the S&P 500. In the bond market on a 2-year, 10-year, 30-year, we look like this. On a 10-year maturity, yields lower by a single basis point, 427.91. The risks have risen. The risks have not materialised. The Fed Chair Jay Powell says we're well positioned to wait.
We don't think we need to be in a hurry. We think we can be patient. We're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low.
So they are going to wait to see the outcome of trade talks between the United States and China, wait to see if this economy breaks one way or the other.
Why don't you just read Moby Dick for an hour and a half? I mean, honestly, if you want to know how the Fed looks when they filibuster, this was it. Ultimately, I thought that line was interesting, that the cost of waiting didn't seem that great. Some people, Neil Dutta, might disagree with that, but this right now is their stance. It is in a good place, and they did not give any sense of exactly what it would do to tip their hand away from that.
His speech at the Economic Club of Chicago repeated in the news conference this time around. If current trade policy is sustained, it could mean higher inflation. It could also mean lower growth. Our job, we have an obligation, Tom, to anchor inflation expectations.
The obligation is there, and of course the reach out is to when will they do something. There's a lot of heated debate. Neil Dutta sent me a note here from Renaissance Macro. He's scathing, is the only word I could come up with, scathing about their delay here. You mentioned Andrew Hollenhorst with a view, and then you go all the way out, dare I say, into next year. The dispersion here is wide. I just want to point out that if he had read the cliff notes of Moby Dick, like I did in college, he could have pulled it off.
Oh, yeah, in an hour and a half.
No mention of transitory this time around. Short-lived or short-lived.
Yes.
Is the new term for the chairman of the Federal Reserve.
Yeah, in the sense that they will get clarity as time goes on, and right now they have none, but it will be made apparent to them as things settle into place. This idea, though, that right now the economy is still relatively healthy is one aspect that I think maybe is going to become challenging in a month's time.
Let's get to the conversation. Joining us now, the former New York Fed President Bill Dudley. Bill, thank you for joining us, sir. They clearly face a range of risks, which, as the chairman says, have not yet materialised. Can you walk us through how you think they've responded to the risks they face and what you make of that news conference from Chairman Powell?
I don't think the news conference is surprising at all. I mean, the Fed is not really sure where tariffs are going to land, which is important. And when they land, they're not really sure what the consequences are going to be on growth versus inflation, and which side they're going to miss their mandate by a greater degree. So I think I was expecting him to say something pretty similar to this. And if I was in his shoes, I would have done exactly the same thing.
I thought that the most notable line was the cost of waiting to see further data seem fairly low. Do you agree with that? Do you think that the cost is fairly low of simply being parked on the sidelines at a time where a lot of people think that there are signs of a rapidly slowing economy?
Well, I think the costs are low relative to the risk of making a mistake. You know, let's imagine that the Fed cut rates dramatically because they were worried about the labor market, and then it turned out that inflation expectations got unanchored and the labor market held up pretty well. That'd be a big mistake. And so the Fed really wants to make sure that they don't go down that path. This is not just about the central scenario. It's also about risk management. Try not to do the wrong thing so that you can respond effectively as things actually unfold. So I think the fact that the tariff policy is not set is important. And the fact that we don't have any experience with a tariff shock of this magnitude is also important. So in that environment, it's sort of like, the Hippocratic oath, do no harm to your patient.
Bill Dudley, part of your charm is you had a day job before the Fed job of actually trying to forecast out the economy. How would you frame that now? You've got the luxury of not being at Goldman Sachs. Can you look out 1 month? Can you look out 2 quarters? Can you model out a fancy McKelvey-Dudley jewel out a year right now? I don't think you can.
No way. I mean, I think the only thing we can say is that the economy, like Chair Powell said, is the economy right now seems to still be in good shape. I think the most important thing I took away from the press conference that people should take on board is the fact that don't take the first quarter GDP at face value. The minus 0.3 reading is all because of mismeasurement. It's basically they counted imports a lot better than they counted inventories. So there was a big drag from imports that was not offset by a big accumulation of inventories. And domestic private final sales, which he brought up repeatedly in the press conference, is really a much more representative measure of how the economy is doing, and it's doing just fine, rising 3%. So I think he put the weight on the right things.
I'd point out Jan Hasius with a 2% statistic for this present quarter, published, I believe, last weekend. Bill Dudley, how does the Fed communicate, given this mess that has been wrought? What do they do in speeches coming up? John and I were talking here as we were looking at PSG Arsenal about Jackson Hole. How do they get to Jackson Hole and communicate to the nation?
Well, you can only communicate to the extent that you actually know what's actually going on. So I think it's appropriate for the Fed not to overpromise or imply that they have some crystal magic ball that allows them to see in the future when the future is actually very cloudy. What I'm expecting at Jackson Hole, frankly, is the Fed to talk about their monetary policy framework review and wheel that out. And I thought some of the questions at the press conference on that were interesting, where Powell admitted that maybe QE could have been wrapped up a bit sooner. So I think they understand that there are some things that they can improve in the monetary policy framework. And so I think that's going to be the most interesting outcome of Jackson Hole.
Bill, we've spent a lot of time speaking to Fed watchers on Wall Street, and they've all said a similar thing, that this time, because of the constraints, they might have to act late. They won't be able to act preemptively. And I guess it's important to understand his definition of being late, because there was this really interesting moment in the news conference, and I'd love your thoughts on it. He looked at the cutting that they did last year, 100 basis points of rate reductions, and said the Fed was a little late to start cutting last year. Just what is the definition of late on the FOMC?
I think late is when you realize that the risk on one side of the mandate have become very predominant. So if the fact is you're only cutting at that moment means that you're probably late, because the risk have really accumulated on the employment side of the ledger. And that's what happened last summer. The unemployment rate went up pretty quickly, and the risk of the labor market sort of unwinding in a bad way increased. And the Federal Reserve was pretty slow to get off the mark, and that's why they ultimately cut rates more quickly than expected. They delayed, and then they cut more rates quickly than expected.
I think that caught John's attention, and it caught mine as well, because some people disagreed and said maybe it was proactive in a way that led to the increase in longer-term benchmark yields, this idea that maybe actually there was more strength than expected in the underlying economy. I just wonder what that means going forward about that 2% inflation target, if we're still not back there. If we did see something of a firming up of the labor market, and yet that still is the assessment from last year.
Well, I think there's two things that are sort of relevant going on. Number one, the monetary policy may still not be as restrictive as the Fed thinks it is. I mean, the fact that the economy is still doing okay with a supposedly restrictive monetary policy in place, I think is sort of is meaningful, at least to me. And the second thing I think is going on that's really important that people aren't putting enough weight on is the labor force is going to grow much slower in 2025 than it did in 2023 and 2024. So the kind of payroll gains you need to keep the unemployment rate stable are dramatically lower this year than last year.
There is this question going forward of what kind of pain tolerance would this Fed be willing to accept before they start to have the clarity that they need to actually make a move. We were talking with Rich Clarida just before the press conference, and he said maybe a 0.5% increase in the unemployment rate, something material that they could point to. What's your assessment that would actually provide clarity at a very unclear moment?
Well, I think Rich Clarida is broadly correct. If the unemployment rate starts going up rapidly, like we go from 4.2 to say 4.6, then the Federal Reserve is going to be thinking, boy, the labor market really is weakening in a big way. We are moving meaningfully away from full employment, and the risk in that environment is that we're about to have a full-blown recession. The SOM roll didn't work well last year, right? The SOM roll, we triggered the SOM roll, and there was no recession. But that happened because the labor force was growing very rapidly, and so the rise in the unemployment rate was driven by rapid labor force growth rather than by layoffs. This year, if the unemployment rate rises rapidly, it'll be driven by layoffs.
Bill Dudley, let me throw in an audible then on that. Given the trade war, given the ballet in Switzerland here in the coming days, are we at risk of damaging the productivity that seemed so successful over the last 24 months?
Absolutely. I mean, this is putting investment spending plans on hold. We are almost certainly going to have supply chain disruptions, even if we were to resolve this tomorrow, because a lot of ships from China aren't landing here at port, coming to port here. And then that means there's going to be a lot less time to replenish stores for Christmas. So supply chain disruptions to some degree are almost inevitable. And that's assuming that you switch things back, you turn the whole tariff thing off almost immediately.
Hey, Bill, appreciate your thoughts, as always. Bill Dudley there, the former New York Fed president. The Federal Reserve see it like this. The risks have risen to higher unemployment, to higher inflation, to lower growth, but the risks haven't materialised. And the risks are around trade talks as well. The President of the United States, in the last 2 hours or so, we've had a load of headlines from the Federal Reserve, but maybe the most important headline came from the President. The President said we're unwilling to lower tariffs to get China to the table. Now, the US is in negotiation mode at the moment, going into talks of the weekend.
Are we?
Talks about talks between the United States and China. And they can dial up and down the tariff-free policy whenever they like. You can't set policy in a moment like this because you don't know what policy is going to be on the other side of Washington. You don't understand necessarily what the supply chain disruptions are going to look like. Let's say they don't lower tariffs in anticipation of these types of talks. China has said that is the only way to start talks. So does that remove the idea of talks from the table entirely, even though they might be seeing each other in passing in Switzerland? The key question here is, how do they start to game out whether this is really a pandemic-like supply-side shock or whether this is something entirely different that can get remediated in the near term? That is the difficulty that they're grappling with. It is different. We've said it so many times on this programme. I've heard all these comparisons to COVID. The difference this time around is you don't have to wait for the vaccine. The President has the vaccine. He can take the tariffs off, put the tariffs on whenever he likes. He's in control of the virus, if that's a good word to use. Probably not. No. But ultimately he is. If you believe there are comparisons to COVID, the President is running policy here. So not some runaway virus that we don't have control over.
Is he the chairman of the Fed right now?
I think he's in charge of what the Federal Reserve's about to do, without a doubt. And this is the problem for the Federal Reserve. Let's just say in a month these talks are fantastic. And the Federal Reserve cut interest rates by 50 basis points, 75 basis points, 100 basis points, because they thought these were the new rules of the game. All of a sudden, policy's offside. And guess what? They're about to deliver a big tax package down in Washington, D.C. as well. That's why this is so hard. Fed Chair Jay Powell alluded to this, saying there are things that can be done, some things, we haven't seen them being done, but there are some things that could be done that could actually cause outcomes to be very different. Key question, and this is something that comes up in a lot of our discussions with analysts and economists, there is damage being done. It's not as if this genie can go back into the bottle so easily, and there are ships that are not going to get here, and there are already supply chain disruptions. So at some point, that is the reason why people are saying the pain is already being felt, the damage is being done. It's now just a matter of magnitude.
But a number of weeks ago, we had a yeah, but where Bessent and maybe Lutnick had to go to the president and say, you're offsides, fix this right now. And what? In 10 minutes, they had it fixed. And that initiated the 90-day pause we have. Yeah. And the negotiations are starting. But if you're the chairman of the Federal Reserve, look, it's an industry to go after the Federal Reserve. We all partake. I understand that. We've been very critical over the years. You do, John? But I have some sympathy with the institution at the moment. I don't understand how you set policy for the medium term in a moment like this one. I think that's the reason why the policy tool that is communication
is now filibustering, because ultimately there is no communication that can be had at a time where there is no information, solid information that can be had. And so maybe we'll get Moby Dick
My
next
sympathy
time.
has limits, of course, you know.
I would
understand
suggest
that.
the Fed is codependent on the president. The president's driving the dialogue right now. It's standard psychiatric work. They're codependent on the White House.
The White House is in the driving seat. Couldn't agree more, TK. Mike McKee was in the room. He's out of the room now. Mike McKee, welcome back to the programme. You said it multiple times, Mike, in the lead up to this. I don't have anything to add on that, Chairman Powell. And Mike, on a number of issues, he didn't have much to add.
No, he didn't. You've been talking about it. The Fed doesn't know what's going to happen. Nobody knows what's going to happen, so you can't make policy. But one thing I would add is that you've been talking about this as a supply shock, which it very well could be. But the Fed was also sending the message today that it could be a demand shock. And if there's a demand shock, it could be reflected in things beyond just the unemployment rate and the inflation rate. We could see people start to pull back on spending significantly because either the shelves are empty or because they think things are going to be bad. Maybe they listened to Jay Powell today talking about the elevated risks. So there's a lot going on, a lot of cross currents going on, and it really comes down to how does all this affect the consumer? And by that, I also mean businesses, because as you reported every day, people are pulling guidance. They don't know what's going to happen. So at this point, the economy could go either way. The Fed's stuck in the middle. And really, there isn't much to say about the Fed for right now, except that they're watching like we are.
Mike, you're a student of Fed history, and I wonder how much this has a parallel in recent history at a time when the Fed is just going to say uncertainty in 15 different ways and then sometimes the same way over and over again.
Well, I think there isn't an exact comparison, but what you might look at is obviously the pandemic, where nobody knew what was going to happen because we hadn't had this happen before. And so the Fed was stuck in a situation where it knew things were bad. It knew it had to do something. But how long did that have to go on, and how far did they need to go? That was the question that was never really decided, and we kept talking about for months and months. But the idea of we've got stagflation out there, but we don't know if it's going to happen. And if it does happen, we don't know how bad it's going to be or when it's going to happen. That I don't see any precedent for.
Michael McKee, for our international audience, brief us right now on, and you and I know the shadow FOMC, iconic at Carnegie Mellon and the rest. Tell us about the Trumpian shadow FOMC right now. Is there coalescing a beast that's going to send signals, send messages, critique Jerome Powell?
Well, there are a couple of different groups going on, you could say. The Shadow Open Market Committee doesn't really have a lot of critiques at this point, other than what we were talking about earlier, the Fed's mission creep, the question I asked him. There are people who are contenders for the Fed chairmanship when the president finally makes a decision who could be having things to say. Kevin Warsh talked last week, the week before, about that. But really, the opposition or the people who are going to raise the question are in the administration right now, because the president wants to influence the Fed. He can't really do it, but he wants to. So there are going to be other people who are going to pick up on this stuff and talk about it. Scott Besant's been asked about it. He was asked about it today. They want the Fed to lower rates, but I think Mr. Besant knows, even if Mr. Trump doesn't, that the Fed can't move right now because they don't know what Mr. Trump's going to do.
Mike McKee, appreciate the reaction. We'll hear from Mike throughout today on Bloomberg TV and on Bloomberg Radio. So we've had plenty of sympathy for the institution. It ends right now. Here's the criticism. It goes like this. I've heard it now from the previous Minneapolis Fed president, St. Louis Fed president, rather, Jim Bullard. I've heard it directly from Mohamed Ali as well, that this Federal Reserve is only really entertaining one scenario. That you hear a lot of people talking about a wide range of outcomes, but emphasis matters at a news conference. And the emphasis with Chairman Powell keeps landing on stagflation without saying stagflation. And Jim Bullard said this, and Mohamed said it as well. What they don't entertain is the prospect of a good outcome, the prospect that the Chinese turn around over the next few weeks and say, you know what, we'll give you what you want. The Europeans do the same thing. And you end up in a situation where you have lower tariffs. And maybe you end up in a situation where you have a reduced tax rate as well. And perhaps by the end of this year, you're in a better position for both the risk assets and growth too. And you don't hear any of that when you listen to Chairman Powell. And I didn't hear much of that at all in the last 90 minutes.
There's a key question here. Is there a scenario in which they would have to hike rates? Is there a scenario in which they don't have to move at all because this is a soft landing in the same kind of way that they used to with no tariffs? There is a positive economic outcome that he kind of alluded to in passing, but it wasn't necessarily the main story.
Yeah, kinda, but not really,
But
right?
not really.
Joining us now to discuss, Jeff Rosenberg of BlackRock. Jeff, I'll make it simple. Is this a moment to own bonds? And if so, where on the curve?
It's certainly a moment to be adding diversification to your portfolio, because the whole theme everybody's been talking about, and Powell answered in multiple ways, is we don't know, and he doesn't know, and it's heightened uncertainty. So you need more balance in your portfolio. Now, the subsequent question is, do bonds give it to you? And there I'd say you got to be more anchored to the front end of the curve. The back end has a lot of uncertainty. You got to look for alternative ways of finding diversification in your portfolio. And beta exposures are just directional. Is the market going up? Is it going down? Is it a good outcome? Is it a bad outcome? As Lisa was just outlining, it's incredibly uncertain. And so it's a time for diversification.
Jeff, this feels like in high school when someone really likes someone else and they keep talking about them ad nauseum and you feel like there's nothing else to talk about and you're kind of sick of the conversation, but you feel like you have to keep entertaining it. It feels like everyone's trying to get into the head of one person again and again and again, and is sort of exhausted by the end of the day. How do you rise above that and understand what's actually happening in the economy in some kind of way to understand which way things are turning?
Yeah, it's a good metaphor. It's a fun metaphor, and a tough question. And I think one way is to really think about it from a portfolio construction point of view of what am I exposed to in my portfolio, right? So if it's about one person and one outcome, that's kind of the antithesis to what we've all learned over the years of how to build a good portfolio. Don't put all your eggs in one basket. In this context, it is don't have all of your outcomes determined by that uncertain and unforecastable outcome. And so that's really about diversifying my sources of return. I've talked about it on this program before. Often all we talk about is the beta outcome, the directional outcome. And there's another good news story here for investors, which is all this uncertainty actually increases opportunities, but if you're investing not in directional space, but in the cross-section. And so you're creating bigger winners and losers in the micro space. There's greater divergences and dispersion in the macro space. And so if you have strategies that are more about betting on the differences and not the direction, you can balance out your exposure to not just one person. That's a really tough outcome, but to hundreds of different outcomes. That's a better chance for success. And that's a way to pivot away from this kind of unipolar focus on that, popular person in high school.
Jeff, I see, well, I don't know. Is there anything else you'd like to add right now?
Jeff, thanks for entertaining that. Thank you.
Come on, you know exactly what I'm talking about.
Was this a Friday night party?
Just pause.
I don't want to get too deep here, TK.
No, but you get the idea that it's just sort of exhausting. There's something more to say or talk about.
Everyone's exhausting. I'll take that from you. There's no question about that. Jeff, off your remit, what I'm seeing is a multi-standard deviation move in selected currencies. Where's your unexpected out there across equities, bonds, commodities, and particularly the depth of the currency markets?
Yeah, I mean, the FX move is really important here, right? And so, let's just kind of look at what's happened in markets since April 2nd is you've had this remarkable rebound in risky assets, equities, sub-equity indices, factor exposures, and we've kind of are above in many of those measures the April 2nd tariff day, Liberation Day announcement. The one exception, a lot of these boxes are the same, which one's different, is the dollar and the FX piece of that. And that's really talking about kind of the global impact here, and that hasn't been resolved because, are we going to be talking about deficit equalization or tariff equalization? The latter is a pretty good outcome to the earlier conversation. You could get lower tariffs. This could be really positive. But the former, which is what was the initial thrust of the policy announcement, is deficit equalization. That's very problematic, and it's problematic to the flip side of deficit equalization is a big collapse in the U.S. capital account surplus, and that's what you see on the currency piece. Yeah. That's the big surprise move. We got to keep an eye on that. And I think that's a really key development, especially as we go through each one of these announcements on bilateral trade negotiations. You're going to look at the voting evaluation of those pronouncements in the currency markets. I think you'll get a good read on.
This goes to the heart of your whole discussion around diversification and balance. How much is that diversification and balance increasingly international as a result of that uncertainty around the dollar and the space going forward?
Yeah, I mean, look, that's a huge theme. You see it in the flows. You see it in the relative equity returns. It's partly what's reflective in the currency that you are seeing from a global investor's perspective, kind of a questioning of the overweighting that has existed in, say, equity portfolios because of the dominance of U.S. capital markets, right? You look at GDP versus market cap differentials, and you have a very big gap. The largest gap is in the U.S. And so that's one way of sort of thinking about where would the rebalancing occur. And the trigger for that is, again, this assessment. Are we going to push further on this policy towards deficit equalization? Then I think you're going to be looking more at equalization between market cap and, say, GDP contributions in the global cross-section.
John, the fiscal debate may get overwhelmed by the actual data of employment and interest rates back to the Fed and all that, but I would go back to what you and I first talked about decades ago, which is Euro-Swissy. And the fact is you have strong Swiss right now, and as Jeff alluded to, anybody in equities, including all our listeners and viewers in the stock market, don't forget to monitor foreign exchange each and every day. The Swiss franc is talking right now.
And these central banks will have a decision to make, how to respond to some of these shocks. And I think it's clear the kind of decision they're making so far. Lisa, we've talked about it. The ECB reducing interest rates. The Chinese coming out, reducing interest rates. The Federal Reserve doesn't really understand the nature of the shock yet. The rest of the world has decided it's disinflationary. Maybe they have the capacity to reduce interest rates in a way that the Federal Reserve does not. But we've talked about this a million times. Trade talks, things can change from hour to hour, never mind day to day. It's only a few hours ago we read a headline from the President of the United States that said he wasn't willing to reduce tariffs to engage in negotiations with the Chinese. And then we have reporting moments ago that says the President is ready to rescind global chip curbs. Now, this is sort of one versus the other. Every single headline moves this market one way versus the next. The Federal Reserve can't behave that way. It can't reduce rates 25 minutes ago and then hike them the next. That's the problem they've got at the moment.
In fairness, a lot of people feel like they can't live like this right now. A lot of traders out there are saying, what's the point? I mean, you see that whipsaw in the NASDAQ in particular. This is something that NVIDIA has wanted. There is this tension between the fast-moving headlines of a tweet or a truth or a statement with the real economy and companies that have to make longer-term decisions. And as an investor, especially where speed was your friend, how do you deal with that in a very different backdrop?
Jeff, are you tired of this yet? How are you feeling?
Look, we're feeling great. This is creating a lot of opportunities if you know where to look and reweight your sources of returns away from the stuff that's impossible to forecast, right? And so, like in this last conversation, this is sort of in our kind of systematic framing. It's like momentum signals versus reversal. Momentum is a really tough strategy right now. Reversal, much better for exactly the description that you're just talking about. One day it's one headline, even within a headline, within a day, the headlines are reversing around. So that creates opportunities if you're weighting your sources of returns to the right environment. And it's just kind of like recognizing, look, the easy momentum macro trade of the post-COVID environment is not the trade right now. It's much more in the cross-section, much more reversal. That's where you can find some opportunities. And if you're trying to predict, what the next trade headline's going to be, that's going to be a very frustrating place to be.
Yeah, good luck to you. Never mind within a day, within the hour. Jeff, thank you, sir. Jeff Rosenberg of BlackRock. The latest reporting from the team here at Bloomberg. The Trump administration planning to rescind Biden-era AI chip curbs, according to people familiar with the matter.
You look at NVIDIA shares, they're up more than 2% on this news, and it makes sense given how vociferously against this they've been. This goes to the question of what is the ultimate goal of some of the tit-for-tat in the trade war that is between China and the U.S. Is it just complete decoupling when it comes to tech? Is this trying to tweak the rules? confusing.
The team will guide you into the close. Good luck to them. Coming up, Jason Thomas of Carlisle, and tomorrow, if you're going to be tuning in on Bloomberg TV, you'll catch up with Stuart Kaiser of Citi, Kelsey Barrow of JP Morgan, Nouriel Roubini of NYU Stern, and the former Kansas City Fed President Esther George. And if you're listening to Bloomberg Radio, TK might steal a few of those guests. From New York City this afternoon, good afternoon.